My name is Andrew Stotts, and I'm going to welcome you to the Valuation Masterclass. What you're going to see next is the final presentation of one of our graduates from Valuation Masterclass Bootcamp. That's a 6-week intense course on how to value any company in the world. Many of our students come in and they know nothing about valuation, but they want to learn, and so they build on that. So without further ado, I'm going to kick off the show. So 1 second. Indra, are you ready to go?
Yes.
That's fantastic. I know you got good stories, good logic, and I like what you say. So I'm looking forward to it. Now I brought your presentation is now up on the screen. And so in just a minute, I'm going to leave this and then I'm going to let you take over. Before I leave, just a highlight for anybody who's viewing this, feel free to leave comments and leave questions that we can ask afterwards. So, all right, you ready to go?
Yes.
All right, I'm leaving now so you can start now.
Okay. Can we start now? Okay. Total Energies. Enduring a bad phase amidst transition buzz. I initiate coverage on Total Energies with a sell recommendation based on a target price of 48 US dollars, implying a downside of 19%. I derive my target price from a dividend discount based model valuation using a cost of equity of 8.1% and a terminal growth rate of 1%. Highlights are LNG to drive long-term revenue during the ongoing energy transition, low growth in the short term due to shifting away from volatile spot markets. Too much diversification away from oil may give bad returns. The risks are risk of low revenue due to shift away from volatile spot markets, unrealistic energy transition goals posing a major revenue risk, risk of oversupply looming over company profits, and market volatility. Now, a bit about the company background. TotalEnergies was founded in 1924, is a French multinational integrated company. It operates in around 120 countries and spans 5 continents. It is one of the 7 super major oil companies in the world, and its business now covers the energy value chain. In 2023, the company ranked number 3 in global LNG production and number 1 in utility scale solar developers. And now, refining and chemicals contributed to more than half of total revenues. Now, the stories. Total Energies is cutting losses to gain long term. LNG to drive long term revenue during the ongoing energy transition. According to ING Think, global LNG demand is expected to grow by 35% till 2030, mainly from Europe, South Korea, China, and India. Total Energies is targeting a 50% LNG sales growth by 2030 and has locked deals with South Korea, China, Algeria, India, UAE, and USA. So Total reported 23% revenue growth in the integrated LNG segment from 2021 to 2023, indicating its expanding LNG portfolio. I predict LNG revenue growth by 6 to 8% year on year through 2028. Low growth in the short term due to shifting away from volatile spot markets. Total Energies has planned to increase its oil and gas production capacity by 3% through 2030. It would face revenue challenges given the oversupply due to the reduced demand from China and disruption in the Russian supply chain. Now, Total has shifted from highly volatile spot markets to indexed long term supply contracts, which may reduce revenues in the short term but provide stable revenues in case of a supply glut, as predicted by IEA. I expect an overall revenue drop of 8% in 2024, followed by a growth of 2% in 2025 and 26. Too much diversification away from oil may give bad returns. The company makes a far fetched claim that it would reduce 40% of its petroleum product sales by 2030, which is absurd given that Total made 59% of its revenue from oil and refining in 2023. The world would still need fossil fuels to function in the near future, and if the company retracts its petrochemical products, then it would reduce its revenue. OPEC predicts that oil demand will peak in 2045, and as such, the company is dependent on the cash flow generated by oil to power their investments in the renewable energy, and reducing those would impact their overall portfolio negatively. Now, about the industry analysis. Oil and gas growing amid slow renewables adoption. The oil and gas industry navigates the seemingly shifting energy landscape. Oil and gas industry is divided into three sectors: upstream, midstream, and downstream. So the oil industry is booming and is expected to grow to 9.3 trillion US dollars in 2028. Saudi Aramco ranks first in the revenue share, and investments in renewables is suggesting that a shift to renewables is underway, but it is very slow and is likely to take a long time. China's renewables adoption likely to bring oil demand peak. So, the share of LNG trucks in heavy duty truck sales jumped from 9% in 2022 to 42% by Q3 2024 in China. This indicates that oil demand is likely peaking or will peak in the next few years, as is evident by their high speed rail network and the sales of EV hybrids. Oil and gas likely to sustain global energy needs despite push for renewables. So oil and gas makes up 55% of the global energy needs. And it is evidently clear that it would make a major portion of the energy going forward. And even though the push for renewables is happening, it is likely to take a long time before the world has the needed infrastructure to adopt renewables fully, but a diversified portfolio is likely to help in this scenario. The Q3 2024 saw a big drop in EBIT margin for Total. Uh, the total in revenue decreased 13% year on year to 47 US billion dollars, and it was driven by lower refining margins in Europe and in the rest of the world. Dropping liquid prices and a decrease in LNG production resulted in a drop of gross margin by 6%, and a net margin was dropped to 7% year on year. The latest news is that TotalEnergies has finalized a deal to buy German renewables firm VSB Group for 1.6 US billion dollars, and it has signed a 25-year power purchasing agreement with the Saudi Power Procurement Company, and it is assessing the potential development of a sustainable aviation fuels plant in Saudi Arabia. Consensus estimates show that over 56% of analysts hold a bullish view on Total Energies, and 10 analysts have issued hold recommendations. Analysts expect a decrease in EBIT margin from about 15% in 2023 to about 12% in 2026, and there is also an expected drop in net margin in 2024. The revenue structure shows that Europe drives majority of revenue. So Total Energy's total 2023 revenue was 219 US billion dollars, and refining and chemical segment contributed to 43% of it. Marketing and services segment made up 23%, and exploration and production made up 16% of the revenue. Total, as mentioned, is the third largest supplier of LNG in the world, and its integrated power section makes up 10% of the revenue. France and the rest of Europe contributes to about 65% of total revenue, and it indicates its strong presence in Europe. North Africa and America stand at about 9% each, and followed by the rest of the world at 17%. Now, the FVMR shows that overall Total Energies has neutral attractiveness relative to 240 non-financial companies in France. It is fundamentally has a strong profitability, which is driven by rising recurring net margin, return on assets, and high recurring return on equity. The momentum is showing that revenue growth and recurring EPS growth have dipped, and price change has been volatile. Profitable growth saw a major dip from number 3 to number 6 in 2022, and it is at number 4 in the past 12 months among 300 large energy companies worldwide. So the company has showed improvement in asset efficiency. Growth has been volatile. It rose from number 8 to number 2 in 2021, and now it is at number 4. It was driven by a massive improvement in expense direction in 2023. Now, expense direction has shown a massive improvement by rising from number 8 to number 3 in 2023, and has remained there for the past 12 months. Asset efficiency has showed slight improvement by moving one place up. Now, this is the profit and loss statement. I predict revenue to drop in 2024 by 8% and then rise 2% each year. through 2028. Net profit, as shown, is also increasing slowly. Net fixed assets are increasing because the assets under construction of the company are increasing as they are investing in a lot of construction projects in both oil and gas and in renewables also. So long-term debt, I predict it to increase from 2023 because, as is mentioned in their annual shareholder report, they are eyeing for investments. And then ratios. So current ratio, I predict it to be basically constant from 2023 because it is showing to be constant from 2022 and 2023. Then I predict that EBIT margin will increase slightly and will keep on increasing. However, I predict that the company may decline. So, no, actually, in recent quarters, it is being shown that the EBIT margin is falling. Net debt to equity is predicted to slightly increase. And return on equity, I predict it to decrease over time. Cash flow data shows that depreciation and amortization are expected to increase, and capex is also increasing. Now, relative valuation. So, on the PB multiple for the year 2025 expected, Total Energies looks cheap compared to the energy sector in France, Asia excluding Japan, and the global market. It this In return on equity is around 13.5% in 2025, which is higher than the sector average in Asia and in line with the global average. But this results in Total Energies trading at a small discount based on the 2025 PB to ROE multiple, which shows that it is slightly undervalued relative to its local peers. Now, the PE to growth. Total Energies trades at a discount to the energy sector in France, Asia excluding Japan, and the world on the PE multiple. So it seems cheap on a PE basis, trading at a PE of 7x. I expect its EPS growth to be negative in 2024 expected, and this results in Total Energies trading at a premium based on the 2025 PEG ratio multiple compared to Asia and the world. Valuation and target price. I assume a risk-free rate of 1.5% given the current interest rate fall and a market equity risk premium for the French market of 5.5%. So for Total Energies, I forecast a capital structure with around 30% debt to total capital. This results in a cost of equity and a discount rate of 8.1%. I use a low terminal growth of 1% and dividend discount model to value the company because it is cutting losses right now and it's recovering its revenue and paying dividends regularly. So, in my base case scenario, I anticipate a gross margin of 30%, leading to a value of 48 US dollars per share based on the DDM methodology. This represents a 19% downside compared to the current market price. Then, in the sensitive analysis that follows, if sales growth is changed by 10%, it is rising to be 49.6, and sales growth is decreased by 10%, then it is going at 46 US dollars. Now, the risks. Future growth hinges on external factors. Risk of low revenue due to shift away from volatile spot markets. Although Total Energies is shifting away from volatile spot markets due to irregular prices to increase their chances of more stable revenue through indexed long-term deals, there is much risk involved in a lot of things going wrong in the contract work out in the future, which may lead to bad revenues. Unrealistic energy transition goals posing a major revenue risk. To comply with government regulations and the narrative push towards renewables, Total is investing in renewable energy and continuously searching for low emission pathways to produce oil and gas. Although this is good for the environment, it is a reality that till an alternative for oil is found, the world will depend on oil and gas for majority of its energy supply. Because developing economies will always need oil and gas for their industries. Total Energies risks losing a major portion of revenue from oil and in turn a lot of their investments in renewables which are powered by oil cash flows. Risk of oversupply looming over company profits. IEA predicts a supply glut of oil from 2030 and an oversupply of gas from 2030 onwards. And this may mean that Total will be stuck in an oversupply situation, which may reduce its revenues. Look, because most of the contracts would start to give returns from 2028. So it is a long way before we see any materialization of their long-term plans. Market volatility, Total's stock price is volatile given the volatile nature of oil and gas markets. It is driven by supply-demand mismatch, geopolitical favors, and market sentiments. Negative news such as the company being anti-energy transition, pollution issues, production shutdown, clean energy activism, and geopolitical turmoil can lead to significant price swings. And as shown in the chart, the total energy stock price is declining, and it has been declining by minus 19% past 6 months. And now I will repeat my conclusion, which I had, which is a sell recommendation based on a target price of 48 US dollars, implying a downside of 19%. And as said above, I derive my target price from a dividend discount based model.
All right. I've got some questions, but before we do, let's
Yes.
go to questions. The first one comes from Hybrid. It was said
Yes.
in the industry section that having a diversified portfolio could help companies
Yes.
as the uncertain over oil carries on. TotalEnergies seems to be that. So why is there a more negative stance that you're taking on their future relative to industry, considering their integrated model?
Okay. Um, just a second. Sorry, can you please repeat the question? I think
So it's a diversified company. Why are you so negative on it?
uh, I am negative on this because the company is investing, but it is not uh, gaining revenues. And most of the revenues it promises, most of the profit it promises are from 2028. So right now it doesn't have anything to show for the diversification.
Okay, and we have a question from uh, Nirvik Paul. It says, what sort of a lag do you think is going to be there for conversion to renewables?
I think the lag would be a lag in developing economies.
All right. Well, I think we had a problem, a technical problem. I think his battery was running out, but that was an interesting presentation about Total Energy. And I think one of the questions that that came in that I thought was interesting was from your presentation, the FCFF and FCEE FE value are the same. Why do you think that is, particularly when there's debt outstanding? That's an interesting question. In fact, it's one of the first times that I've seen that. I'm going to go look at that. Meanwhile, if you want to build a competitive advantage in company valuation, join us at valuationmasterclass.com. I'll see you in the next boot camp.